So in this video, we are going to look at what is life cycle costing. So life cycle costing is not a costing method like job costing, batch costing, or process costing. So these types of costings are applicable only to a particular type of companies. But life cycle costing is very general in nature. It could be applied to a variety of industries, okay? And its approach is also like quite difficult, okay? Sorry, it's quite different. Costs Costs considered include the financial cost, which is relatively simple to calculate, and also the environmental and social cost, which are more difficult to quantify and assign numerical values. So life cycle cost considers costs which are like direct and straightforward, but also it considers some of the hidden costs which are not properly taken by other costing methods like job costing, batch costing, or process costing here. So assume that we are going to manufacture a bike. So we manufacture a bike or we produce a bike. So what are the costs involved in the production of a bike? So the raw materials can be one expense, or two, the components, the labor used to produce the product, and any overheads, any costs which are associated with this. And if you're going to consider not only the production but also the sale, also the sale of the bike, so there are some more expenses which are involved. For example, distribution expense, so distribution expense would be involved, or selling expense, or sales commission, or advertisement, right? So these are the normal costs we consider. Is there any other cost apart from this? Okay, we usually don't consider any other cost apart from this, because we have taken the cost from purchase of raw material, okay, to the production of it, to the distribution of it, and finally the sales and the advertisement, okay. So we only consider from the production point to the sales point of the bike. Is there any other cost? The answer is yes. There are some costs which are incurred even before the production of the bike. So for example, what about the R&D cost? Okay, what about the research and development cost? So R and D cost. Okay, so what about the R&D cost here? So this cost is incurred, and even before the production of a bike. So for example, here we get the design. What should be the design? Even before the design, we go for a survey and we ask people's opinion, like what type of bike they want, and we then design the bike itself. Then we create a prototype and we test that prototype. Okay, we test it. Sometimes we drop the idea, okay. Sometimes we proceed with the idea, so or getting a license to do all these things, okay. So there are some costs which are incurred even before the production and sale of the bike. So that is, these are the R&D cost. So is there any other cost which is involved after the sale of the bike? So usually we don't think of any cost which is after the sale of the bike, but there are some costs which are also incurred. For example, okay, for example, okay, we can take an example of after sale cost. So what is an after sale cost? See, it could be a warranty cost. We would have given a warranty, a 2-year warranty, like whatever repair happens, we'll repair it for you. Or we could give a guarantee, or we give free service for the first year. All the service that we give are free, so we give free service to the customer. So apart from that, see, apart from here, we also have to maintain the spares. The spare parts have to be maintained. So that cost we have to consider. because assume that uh, we have sold around some 1,000 bikes, okay, and each bike costs us 50,000. Okay, so how much of amount is like totally we have the production cost has been, let's see. So you could see here, or we'll just like make it much more simple, we'll just put 100 bikes. Okay, we have sold just 100 bikes, and that itself comes to 50 lakhs. So 50 lakhs of bikes we have produced, and we could have also sold them. Okay, we could also sold them, but even when we sell 50 lakhs worth of bikes, we have to maintain the spares, right? We have to maintain the spare parts. So at least for 10 bikes spares we have to maintain. So these spares would be, okay, at least 10 bike spares has to be maintained, and totally that spares itself comes to around 5 lakhs. So out of 50 lakhs amount of bikes which have been sold, we have to maintain the spares for 5 lakhs. So the spares have to be stored properly, okay, in a secure place. We should have a godown for it. Okay, it should be easily available to the customer when he requires it. So if the spare parts are not required, okay, what he will do is he will create a bad opinion about the company. Okay, with all his friends, relatives. Okay, he could take on to the social media here. So the concept here is, do not do anything which affects the company's reputation here. So spare parts have to be maintained, even though it is costly, we have to maintain it. So see, again, this is a cost which is incurring after the, okay, after the sale of the bike. So we do not usually consider the R&D cost or the after sale cost. We only think that the production cost have to be considered, and sale of the bike cost, that has to be considered. But what about the cost uh, before and after that? So life cycle cost, okay, life cycle costing considers that. Okay, so that's where you have this concept. So that is the usefulness of life cycle costing. Okay, and it's also like applicable to some other companies also. For example, if you're running a mining company or something, so there is an environmental cost that we usually don't consider. Okay, environmental cost. Or even if you produce a bike, okay, there is an environmental cost that we have to bear. For example, the discharge of waste, okay, or the total amount of carbon that the company has emitted, okay, has been a reason for the emission of carbon, like that. So these are like environmental costs which are usually not considered. And for example, the scrap of the bike, if the bike has become so old, okay, they are going to scrap it, the customer is going to scrap it. Then what about the environmental damage that scrap is going to cost, or is the company would buy it? So scrap and its damage, so that can be a lot of things here. Okay, so the company has to consider it. For a bike company, usually these are not usually like costed. But if you take a company like mining, or a nuclear power plant, or a thermal power plant, or like that, then these become a uh, very kind of high cost for them. This kind of uh, end of the life cost is a very high cost. So in developed countries, if they have, if any company runs a factory, that factory has to be like dismantled at the end of its life. So that is going to be a huge cost. In India, we don't worry about anything. So the next one is typical areas of expenditure which are included in calculating the whole life costing includes planning, design, construction, acquisition, operation, maintenance, renewal, rehabilitation, depreciation, and cost of finance and and replacement or disposal. So look at here. Normally we don't consider these costs. We only consider like operation cost, maintenance, like that. but there are some costs which are like spanning a lot. Okay, they span a quite a lot. So those costs are like very important for a company point of view. So where is this life cycle costing, okay, can be applied? The whole life cost analysis is often used for option valuation when procuring new assets and for decision making to minimize whole life costs throughout the life of an asset. So where else can we use this? Okay, see, we can use it in any decision making also. We can use life cycle costing in any decision, making also. So for example, you want to buy a car. Okay, you want to buy a car. Okay, so what is the cost you will consider? The question is, what costs will you consider? Okay, so assume that you have two options. Okay, you have car model A and you have another car which is car B. Okay, you have like two cars. So normally people, when you ask them, they will say that I will consider the purchase cost. What's the purchase cost? So they will simply say that this car is going to be 5 lakhs. Okay, and this car is going to be 8 lakhs. But what about the mileage? The mileage would be, this car would give you around some something like 15 mileage. Okay, and this car could give you 20 mileage. So that would be a difference. And what about the annual maintenance cost, AMC? AMC would be, for this car, in a year you have to spend 50,000, and here you have to spend around 80,000. Okay, you have to spend around 80,000. So in terms of scrap, after 5 years, what will you do? So scrap would be, this car could be sold for 2 lakhs and this car could be sold for 4 lakhs. Okay, so the thing is, you have to consider not only like the purchase price of the vehicle, you should also consider the running of it, the maintenance cost of it, and the scrap value of it. So all these things have to be considered, put into consideration. You have to consider all these costs here. So from its purchase to the disposal, you have to consider this. And for example, some companies have their own exchange showrooms. For example, if you take Maruti has its own exchange, or Mahindra has its own exchange. If there's going to be any exchange by the same company, okay, they would give you like a better resale value. They could give a better resale value. So you have to consider all this. Okay, you have to consider the warranty. What's a warranty period? So what is he giving as a warranty period? Well, for example, this car might give you just like 3-year warranty, and this car might give you a 1-year warranty. Okay, so, and what about the service cost? Okay, the replacement. Okay, the replacement of spares or something. So AMC is like you are just maintaining it. What about the spares that you have to purchase for the repair? So your tire might worn out, or your brake lining might get failed. Okay, all these costs you have to consider. So this is little bit difficult to consider unless we have a proper kind of a mechanic or a proper kind of a technician, car technician. We can't find it out. So hope you got the idea here. So even for a purchase of a car itself, we consider so many things. Even for a purchase of a car, we consider so many things. Then just imagine, for the construction of a factory, how much uh, things we have to consider, how many variables we have to consider. So that is what the cost here, the idea here about life cycle costing. So we consider the life cost throughout the life of an asset. It is also applied to comparison of actual cost for similar asset types and as feedback into future design and acquisition decisions. So companies, what can they do? If they have already like produced a bike earlier, they can take that cost and they can find out whether a new bike has to be created and what would be its life cycle cost, okay, both for the company and for the customer. The primary benefit is that costs which occur after an asset has been constructed or acquired, such as maintenance, okay, operation, disposal, become an important consideration in decision making. Previously, the focus has been on the upfront capital cost. Okay, what we paid to buy or what we paid to create is the cost. And organizations may have failed to take account of the longer term cost of an asset. So you should not only consider the purchase cost, you should also consider a lot of other costs. Previously, the focus, it allows an analysis of business functions interrelationships. So we think that production is a different department, or R&D is a different department. No, see, whatever cost, whatever like design the R&D department is going to make, okay, the production department has to buy raw materials, components, and has to produce the bike in as per that uh, design only. They can't like go off the design. So R&D cost is not a separate cost from production. So R&D cost is like very important here, because whatever like product we are designing and we are creating, that is what would be like produced by the production department. So we should not like consider this as a separate cost and other things as a separate cost. Low development cost may lead to high maintenance or customer service costs in the future. So we should not like focus on poor quality products. Okay, we should focus on the uh, longer term win-win for both the customer and the company here. So we should ensure that at the development itself the product is of good quality, okay, and meets the customer's requirements. When making this calculation, the depreciation cost on the capital expense should not be included. So don't include the depreciation, he says. Okay, so this is about the concept here, and this concept can be applied to environmental costing also. We could also extend it to environment. So for example, in after sale we also consider the environmental. Okay, you can extend this concept there also. So the idea is here is so the idea here is we'll do a sum here, and we'll get a grip of how to work out this kind of a problem. Okay, so only this part of the problem we are going to do. So it is a 6 mark problem. Okay, it is a little bit smaller problem, so we'll consider from here. So Fitco specializes in manufacture of a small range of high-tech products for the fitness market. They are currently considering the development of new type of fitness monitor, which would be the first of its kind in the market. It would take 1 year to develop, with sales then commencing at the beginning of the second year. The product is expected to have a life cycle of 2 years before it is replaced with a technologically superior product. The following cost estimates have been made. So these are the items here. You have year 1 item, year 2, and year 3. So 3 years are there. And units and manufactured and sold, R&D cost, product design cost, marketing cost, manufacturing cost, and it has two elements here. One is variable and the other one is production and the fixed cost. We have already seen this in the basics of cost classification. Then we have distribution cost, variable and fixed, selling cost, again variable and fixed, and finally administration cost. I think this is fixed. So we have all these costs here. Our job is to find out required, calculate the life cycle cost per unit, okay, and ignore the time value of money. I think this we can directly ignore, no worries about that. We have to find out the life cycle cost per unit. So we'll start. So we have R&D cost of 1,60,000. See, all of these are cost. There is no income here. So we're not trying to find out the total income. We are trying to find out what's the life cycle cost per unit. Okay. So we have to add all the cost. So from here we have manufacturing cost. So we have variable unfixed. So what we'll do is we will work out okay, we'll have the I think we can do workings below. Okay, we'll do some workings below. So variable cost of production is 40, and that has to be multiplied by the with the units. So that would be 40 into 1 lakh. Okay, it would be if you want we'll put there, or I think we could okay. So okay, so there is manufacturing cost per unit is 40 and units is 1 lakh. So we have to multiply it. So 40 into 1 lakh units is this amount, and 40 into 2 lakh units is this amount. So we can copy both and we could paste in the second and third year. So that is done. Next is going to be fixed. So fixed manufacturing expenses 6,50,000. So next is distribution cost. Again we have variable and fixed. So variable we have to work out. Variable cost is okay. See, again we have a problem here. Okay, the problem is the manufacturing variable cost is 40 for the second year, but 42 for the third year. Okay, so we can't work out like again like that. So we have to rework. Okay, sorry, we have to rework. So if I thought that the per unit would be the same amount, but it's a different amount. So it was 42 here in the first year, 40 in the second year, and 42 in the third year. So our year 3 cost would be 42 into 4 lakhs. Okay, third year per unit into third year units. Let's get the answer. So we got the answer. So this is the answer we should have put that. So that's done. So let's go to distribution cost. Distribution cost is 4 per unit in the second year and 4.5 in the third year. Okay, units are going to be same. We don't have any difference in the units. So we'll multiply 4 per unit into 1 lakh units, and here we'll multiply 4.5 into 2 lakh units. So we got two amounts, 4 lakh and 9 lakh. So we got this number 2. So we will move on to the fixed. The fixed is 1,20,000 and 1,20,000. Okay, so that's not a different number. Then we have selling cost. We have selling cost, and again we have variable and fixed. So variable we have to work out. Variable is 3 per unit and 3.2 per unit. Units are going to be the same. And what is the cost? 3 into 1 lakh units and 3.2 into 2 lakh units. So we got both the amounts. Okay, so our variable is 3 lakh and 6 lakh 40,000. So let's get the fixed. Fixed is 1 lakh 80,000, and third year also it is the same. And finally we have manufacturing cost. Sorry, we have administration cost. So administration cost we have for year 1 itself, we have that's 2 lakhs, then 9 lakhs, then 15 lakhs. So add all, we'll get the total costs. Add up to the R&D cost, don't add the units. So this is the total cost. So let's get the total life cycle cost. Okay, so that's going to be the sum of all 3 years. And what would be the cost per unit? So total number of units is going to be 3 lakhs. Okay, so the 1 lakh plus 2 lakh. Okay, so we could put it here. So it is about that 1 lakh plus 2 lakh. So 3 lakh units is what we are producing. So what is the life cycle cost per unit would be So it would be 24691234 divided by 3 lakhs. So the answer comes to 82.3. So the total life cycle costing is 82.3. So the company has to charge more than this. So why it is life cycle costing is, see, they are taking into account the R&D cost, the product design cost, okay, and even the administration cost even before the production has started, okay. So they could have easily missed out. They could have easily missed out in these costs, and also there is a marketing cost even before the sale. Okay, so the company is like only manufacturing in year 2, but a huge amount of marketing cost is involved in the year 1 itself. So that is why we have to consider the cost even before the production starts. So that's about this question. Okay, that's about this question. Hope you got a good idea here. It's a straightforward question, but it tells you like what is the important crux of the problem is. So we'll move on to the second question in ABC. So we have another question in sorry another question in life cycle costing. So we'll start from here. Even though the question seems to be like very lengthy, we could do it in a quite short time. Okay, because the question is not that, the answer is actually not that big. The question is big. So we'll start. Usually when there's a big question, usually start from the required. So this is the required here. Only the first one we are going to do. Recalculate the estimated lifetime cost per unit for the webcam after taking account of points 1, 2, 3. Okay, so the first, these 3 points you have to take into account. They have not taken that into account. So we have to revise what they have done. So Camco manufactures webcams devices which can provide live video and audio streams via personal computers. It has recently been suffering from liquidity problems and hopes that these will be eased by the launch of its new webcam, which has revolutionary audio, sound, and visual quality. The webcam is expected to have a product life cycle of 2 years. Market research has already been carried out to establish a target selling price and projected lifetime sales volume for the product. Cost estimates have also been prepared based on the current proposed product specifications. Camco uses life cycle costing to work out the target costs for its products, believing it to be more accurate to use an average cost across the whole lifetime of the product rather than potentially different costs for different years. So the company, what it says is they want to go for a life cycle costing. Okay, so they don't want to see the cost of a product keeps on changing when you produce more, when you decrease the production, it keeps on changing. But what they want is they want an average cost which can be applied to the entire life cycle of the product. So that's what they are asking here. So projected lifetime sales volume is 50,000. Targeted selling price per unit is 200. So that is what they are trying to sell it. The profit, their target profit margin is 70. This is what they're aiming at. The cost per unit, okay, they want to have this much of cost, but when they have worked out, they have already worked out the lifetime cost per unit, and that comes to 160. See, they have to produce the product at 130, okay, and it's currently 160. So let's see what we have to do. So he tells us direct material, so these are bought in parts, is 40, direct labor is 26, machine cost is 21, labor quality cost is 10, rework is 3. Okay, all these put together is 100, and the product development cost is 25, marketing cost is 35. So put together all comes to 160. Now the average market price for a webcam is currently 150. Okay, So that is the market price. So if they are going to produce at 160, they'll only incur a loss. The company needs to close the gap of 30 between the target cost and the estimated lifetime cost. So they have to bridge this gap. The following information has been identified as relevant. So number one, direct material cost. All of the parts currently proposed for the webcam are bespoke parts. However, most of these can be actually replaced with standard parts costing 55% less. Okay, so whatever cost they have given, we can produce it at a 55% less. Okay, so first we'll do work out that. I think we have to rework. So that is the concept here. So let's rework. So it's going to be particulars, then we'll do some calculation or something, then we'll find out the amount. So it is going to be direct. So we'll start from direct material. So they say all of the parts currently proposed for the webcam are bespoke products, and they could most of these parts can be, most he says most, okay, he doesn't tell how much. Most of these parts can be replaced with standard parts costing 55% less. Okay, however, three of the parts which currently account for 20% of the estimated direct material cost cannot be replaced, although an alternative supplier charging 10% less has been sourced for this products. Okay, so rather putting the sum here, we will work out a little bit lower here so that we have all these points. So let's see. So we'll take, see, there are two types of components here. So one is going to be replaceable parts and the other one is non-replaceable parts. Okay, we'll have like two. So the total material cost is 40. Out of that 40, 20% can be cannot be changed. Okay, that means 80% can be changed, right? 80% can be changed, and we could buy that products at 55% less price. Okay, that means only 45% is going to be the balance cost. So whatever the cost is, okay, we are going to buy it only at a 45% lower price. So sorry, 55% lower price. So the price would be like 45%. The second part is going to be again the same thing. Okay, I think we have to put 80%. Sorry. So the non-replaceable parts are 20%, and we can maximum, okay, we can get a discount. So if we get a discount, our price will not be 100%, it will only be 90%, because 10% is a discount. So first we'll get these answers. So there's no particular formula or method or anything. We have to understand the what he requires and we have to work it out. Direct labor cost. The webcam uses 45. See, this is something like an additional question. Okay, so we can't do this one. So better what we'll do, we can't do this one. This is a learning curve kind of a problem. So better what we'll do, we will take what cost is like given there. So direct labor. So direct labor is 26. Or we'll assume, okay, we will assume after the learning curve is done. Okay, after the learning curve is done, the answer is 10.5. Okay, so we'll just assume, because if we do learning curve we'll get 10.5, but either way we'll work it out. Rework. So the last one is rework. So if it's going to be rework means So other cost would be like what it is given then. Machine cost is 21. So this is the average rework cost per webcam and is based on an estimate of 15% of webcams requiring rework at a cost of 20. So what he says is how this number of 3 has occurred is 20 into, okay, 15% of the webcam will get repaired and it will cost 20 rupees to $20 to repair it. So 20 into 15% is 3. So that's how they got that 3 here. Now, with the use of more standard parts, the rate of reworks will fall to 10% and will cost only 18 to repair. So the earlier number can be removed. So now we are going to get only 10% of the repairs and each repair is going to be only $18. So the answer will come to 1.8. So done with that. So other costs would come as they are. So product development costs is going to be 25 and marketing costs would be 35. So let's find out the total life cycle costs. Okay, so it has fallen to 125. They wanted to produce the product at the target cost was 120, so they have come up to 130. They can even reduce it to 125. Okay, so this alone is an assumption that we made. Except for that, okay, except for that, this part of the answer is correct. Okay, so that's about the life cycle costing here. So we'll move on to the next problem. So this is a quite lengthy problem. Okay, even when we scroll, it's a lengthy problem. So what we'll do is, okay, we'll slowly read it, okay, and finally what the record he wants is using your answers from part A2. So this is the answer from the part A2. Calculate the average net profit per liter of each of the three alternative new products over their expected life cycle and comment on the results. So they're asking you what would be the life cycle cost and the life cycle profit, and we have to tell a comment. Okay, which alternative thing is like better? R&D cost alone they have already worked out and given us the answer. Our job is to use this and to find out the answer. Okay, we have to find out the answer. So they have given us a state of a numerical statement here, but we also want to have theoretical discussion here. Okay, so this question is very lengthy. Better you can pause the video and you can read the question by yourself, and if there's going to be anything additional or like useful, okay, for numerical purpose, that alone we will try to explain. So I'll just scroll the mouse. You can read along. So they are already using a product called as ALF6, and this ALF6 is like has been a failure. Okay, so they are like finding an alternative to this, and the alternative is these products. Okay, ALF7. So this product has lower R&D cost, but is it an effective product? The answer is no, it's not such an effective product. But we can put like this: this has a lower R&D cost. Okay, so let's see for the next product. So if you see here, this product is a new product, and they don't know how effective this would be. So what they say is they have to spend 4 million for each years, and this would be for 15 years of study and 5 years after it. So it's going to be 20 years of research and 4 million for each year. So totally it comes to uh, 20 years into 4 million, 80 million of cost comes into play here. Okay, so if this production of red is going to be like produced, this would lead to a construction of a factory, and that factory has to be fully cleaned because it is very toxic. To clean that factory itself, it will cost 45 million. Okay, so that is the problem here. So there are two types of costs involved. One is this 80 million of R&D, which is an upfront cost, and 45 million of decommissioning and or cleaning cost, which have to be incurred at the end of the product life. So let's go to the third one. So this product will be only in production for 8 years. So thereafter we can't use this product, and it also requires a large amount of energy to produce this. Okay, so that is also an environmental cost or a hidden cost, and R&D is also going to be a high amount, and it is not suitable in all areas of production. Okay, so let's go through the other paragraphs. Okay, so the GFPO has agreed to make a significant contribution to the R&D cost of producing replacement for LF6, but will be unwilling to contribute to the R&D cost for green because it cannot be used in every region. Similarly, a number of governments. Okay, so even though the green product is like environmentally friendly, this product will not be welcomed by the people, and it is also going to be difficult to get funding to develop the green product. Okay, so the funding has to be self funded. Let's see the other paragraphs. Okay, so they have prepared a P&L for these products. So the P&L is, they say, is very simplistic, and the cost of waste treatment are apportioned based on the expected revenue of the new product. Okay, so any waste treatment is apportioned on the basis of how much revenue it generates. So that won't be a proper thing, because usually waste treatment has to be not apportioned but allocated to that particular product which is generating that waste. Okay, so that seems to be wrong. So so this is the revenue per liter for all the three products. The quantity sold and produced million liters. I think this should be for a per year. So this is the revenue. So they have multiplied it. So this is the energy cost, factory cost, environmental study cost, and waste treatment of byproducts cost. Okay. So they have given some kind of a note here. Okay. So all these numbers are excluding the contribution. Okay, excluding the contribution or the funding from the GFPO. So how much is the funding has not been given. The amount of funding is not given, but I think here, right, to make significant contribution only. Okay, so amount is not given or percentage also is not given, so we can't work out that. But we can simply say that for green product it is not available, and waste treatment is. Okay, so here he says the total cost here. The total cost is 55 million of waste is there, and for the 55 million of waste they are spending 300 million. So currently they say that this is a current cost. Okay, so we can easily find out the waste per the cost of waste per liter, and that can be easily multiplied by the liters for ALF, red and green. Okay, that we can multiply. So let's see R&D cost here. Okay, so again they say that the total R&D annual cost is 60 million, and it and 30,400 R&D hours is available, and it will take 800 hours to develop ALF, 8,500 hours to develop red, and 4,000 hours to develop green. So they've also said that. So we could, I think, without this working note also we could work out this. Okay, we can work out. So the main consideration is going to be this part. Okay, and some additional information from the above paragraphs we can work out. So we'll start. we'll put some working notes here if required. So products are ALF 7, red and green. So the revenue I don't think will be different. Okay, so all these numbers are in dollars, okay, or dollar million. So revenue as it is, we can just take it. Okay, so before this we have to get the life of it. Okay, the life is also important because all these are for 1 year. Okay, these are for 1 year. So let's find out the 1 year income and expenses. Thereafter we will add the lifetime, okay, income or lifetime profit. We will then find it out. Okay, so let's get the yearly income and expense. So this is per annum. All these are like for 1 year. So direct material, labor and energy. So environmental study we can't take here because it comes under life cycle. So we'll put it here. So we also have the R&D cost, which is not taken into account. So let's see any previous paragraph if any numbers or years or anything is like given. So let's see. So ALF, the life of red ALF is going to be 3 years. So I think we'll take it from here. So we'll put it here. Life of product it's going to be 3 years for ALF. Let's see for this. And here if you take here they have that environmental study. So we can take that environmental study that we typed here. So environmental study is going to be for 4 million. Okay, for each of the 15 years that the product will be in use. So the product will be in use for 15 years there. Okay, red will be used for 15 years, and environmental study cost would be 15 years plus 5 years after that, both put together multiplied by 4 million per year. So that would come to 2080. So that's a cost, so we'll put it as a minus, it's 80. And there is also going to be something called a decommissioning or decommissioning cost. Decommissioning cost means closing the factory, so that is going to be 45. Let's look at green. This is expected to remain in use for 8 years. Okay, so funding is not available, but funding information or percentage is not given, so we can't work out that funding information here. So let's get that. We'll put all these here. So let's see, we have any other information. So environmental study information we can put, that's 80. And life of the product, that also we can take into account. And decommissioning cost is a cost. That also we'll put. So still we have two things. One is waste treatment, and waste treatment is there, and we have R&D cost. Okay, we have two things here. So let's work out these. So let's put a working note and we'll do it. So first we'll do waste treatment. So if you take waste treatment, they say that each year there is going to be, so waste treatment is going to be, okay, waste cost per liter, that number is going to be with 300, okay, million divided by 55. So that will give you an answer of how much? 300 divided by 55. Okay, this is the cost incurred for per liter. So totally how many waste liters are there? The total waste liters are going to be 12.5 liters of ALF to be produced. So how many ALF is going to be produced? Okay, that they have given. Yes, they have given it here. So 185 and 75. So these are the liters 85 and 75. Okay, so these are the waste liters, and we can't say this as waste liters. These are the production liters. Okay, waste liters are going to be 12.5. Okay, 1 liter of waste will be produced for every 12.5 liters. Okay, so it is 1 liter for every 12.5 liter. Here it's going to be 1 liter for every 2.5 liter, and here it's going to be 1 liter for every 100 liters. Okay, so let's get these numbers properly. Okay, so these are the waste liters. So this waste liter, okay, has to be for per year. Okay, that we have to get waste liter per year. That's going to be how much? Total liters is this. Out of this, waste liter is this. So we'll multiply. So these are the total waste liters that will be produced per year, and the waste cost, okay, per liter is going to be this amount, because the company has a lot of other products also which produce the waste. It's not only this product. So what is the waste cost? Okay, we'll find out that waste cost per year. Okay, that we have to find. So before finding out, we'll first put waste cost per liter. So that's nothing but this number. It is going to be 5.454. It's going to be same across here. So it's 8 liters into this one. So this is a per year cost. Okay, it's not for this is the per year cost. So we'll put all these numbers here. Okay, not here. It for 1 year we'll put. So we have to put it here. So we'll remove from here. We don't want that. So waste treatment we have done. We have done environmental study. We still have R&D cost. So R&D cost is going to be so R&D cost we have to find out. So R&D cost is going to be per year, cost per year. We have always worked on 60 million, so we'll use it in that manner itself. So 60 million is spent for 30,400 hours in a year. Okay, in a year, and this is a one-time cost. Okay, this is a one-time cost. So R&D cost for developing, this is a one-time cost. It's not like they are going to incur it year and again. So let's work out this number. So this is a number that we got, and this number has to be multiplied. Okay, this number has to be multiplied. So okay, so hours required, R and D, hours required is, here it is going to be 8500 hours, sorry, 800 hours, 8500 hours, and 4000 hours. So this is a one-time development cost because they have given like that only. So the annual cost of the facility is like this, of which 800 hours will be required to develop this one, and this one. Okay, so it's not a recurring cost. So as it's not a recurring cost, we'll put it here. So we have got all the numbers. We'll find out the profit per year is going to be, I think we can sum all the numbers. Let's see. Waste cost is also a negative number. So the sum is going to be, add all this, you will get your profit per year. But we don't want profit per year, we want the total profit over its years. Okay, so over its lifetime. So over its lifetime is profit per year into life of the product, in years. So it is total profit over lifetime would be multiply both. Okay, so this is your profit over the lifetime. So let's get the life cycle profit. Okay, we have to get that. So we have got the total profit over the lifetime. That does not have not considered these costs. Okay, so let's consider these costs. So the total life cycle profit would be, this is the profit and this is the R&D cost. Okay, so this is the total. Okay, this is the total profit that occurs over the entire lifetime. But what we want, okay, what we want and what he requires is calculate the average net profit, okay, net profit per liter of each of the three alternatives over their expected life cycle. Okay, so he doesn't want just the total life cycle profit. Okay, he wants over its lifetime. Okay, what would be the implication? So we have to do two things here. One, we have to find out what is the average, okay, average life cycle profit. Okay, we don't want the full one. Okay, profit. And thereafter also it doesn't end. It ends with average life cycle profit per liter. For 1 liter, what would be the profit he wants? So to find out, we need the liters produced and sold. That also we require. Okay, so how do we get the average life cycle profit? Very simple. Take the total profit divided by the number of years. So this is the average profit you will get every year. And what's the per liter? Liters are in a year. In a year, they will produce 100 liters of this, 85 and 75. So the number we have had here, is the average profit per year, and this is the liters produced and sold per annum. Okay, so divide both, you will get the profit. So this number divided by this number, this is the most key number here at the end of the problem, which is average life cycle profit per liter. So whichever is higher in this concept, okay, this area, that has to be produced. So if you see here, when you consider the average life cycle profit per liter, okay, every liter, then green seems to be the perfect one. As per their calculation, they have considered only red seems to be the amazing product. Okay, and also it gives you the highest profit per liter. But when you consider other costs, for example, decommissioning cost, environmental study cost, okay, then it moves the product. Okay, it moves the product towards green being a better product. Okay, and also if you see, revenue wise, red is better, right? But the total amount of direct material and labor and energy required, red seems to be again better. Okay, sorry, red seems to be like little bit bad. Where they're absolutely bad is in the waste cost. In the waste cost, they are like absolutely bad. And that is why the profit per year, okay, in the profit per year itself, green has scored a lot. Okay, and in the total profit over its lifetime also, green has scored a lot because it has 8 years of time. But where it really green scored a lot is in terms of the decommissioning and environmental study. Also red has higher cost. Okay, so that's about this answer. Okay, this is the life cycle costing answer. This is a very lengthy answer, right? This is a very lengthy answer, but still we have got it. So, and that to see, the hint is this: we have got the R&D cost as per the hint itself. So that's about this concept here. Hope you guys